One of the things that we're going to need in the future, we don't need it for last year, but we need it for going forward for 2021, is we'll need to know if the sale of an asset was through an entity or by the human directly. We don't need this for last year, but we will need it going forward.
Okay. Yeah, is that for the 180?
There's different timing rules.
Yeah. This is a year long for entity, right? Versus a individual.
So again, for 2020, we don't care. For 2021 going forward, if the entity sells, then the 180-day begins on the date of the sale. If they don't choose to actually invest, then the owner then has a series of different days based on when they can invest. So it can be the date that the entity sold, it can be the end of the year, it could be the tax return, date, it could be all sorts of dates. So we just need, to be clarified on a going forward basis, whether this was through an entity or not.
Yeah. I would suspect almost everybody's investing with individual, but I'm sure there's a few edge cases. Okay, it's 12:04. I want to be respectful of everybody's time, and thanks, Steve, for attending our Q&A with investors. So everyone here is an investor in the QOZF that you helped set up, Steve, and obviously it's tax filing season. We will be sending K1s for your capital contribution for 2020. For those who contributed 2020, I think everyone did. And wanted to give you guys a chance to ask any questions to Steve on the specifics of QZS or tax filing your taxes. Steve is a prominent expert in this space. So I will kick off the chat so Patty, you have a question. Do you want to just answer it?
Yeah. Hey, Steve. Good to meet you. Thanks for the help.
Sure.
I'm not sure if you can see my earlier chat on the panelists, but I have 4 questions. I'll start with the bottom one first. What to expect with the 2020 K1 for the JAX OZ, since the building hasn't started or completed? Guessing that most of the K1 with accelerated depreciation will be in 2021.
Right. So in terms of the K1 itself, there's going to be, all it's going to do is really provide what your percentage of ownership is and what is your capital account. That's what's going to be on the K1 itself. But you will also have to file. So depending on the kind of asset you have, so let's say I'm going to use an example of stocks and bonds. So you're going to report your gain on the Schedule D, because that's where you would normally report your capital gains and losses from the sale of stock, number 1. And then number 2, you're going to file a form called 8949. And what that does is think of it as kind of a summary form that says, I've invested in an opportunity fund, and the amount I invested, I'm going to make up a number and say you invested $100,000. And so your capital gain on your Schedule D says I've had some sales this year, and so then your 8949 is going to basically say I've invested $100,000, and so then that number is basically bracketed out, that your gain would normally be 100, but now it's 0 because you've made this investment. The other choice of what you might have would be, let's say, a trade or business asset, which could include real estate or could include something else. And so your choice is you're going to fall under either a 4797 or a Schedule D in terms of the kind of asset you sold, right? And that's where you say I sold 100 shares of Amazon, and then I invested in a fund, and so you'd have the name, the tax ID number, and then this bracket in. And then the 8949 is a summary for the IRS, so they can keep this form and say, what have you invested in this fund?
Got it. Yeah, most of mine is going to be Schedule D, so it should be straightforward.
Right. And you can actually choose which investment you want. So if you have various, for example, collectibles is 28%, depreciation, recapture on real estate is 25%. You can choose the asset that you want to be the one that absorbs, that is deferred. So that was that was one question. What else you got? We're on a roll.
If I still have the floor, I'll keep going then. I also have to refile my 2019 because I'm pulling some cap gains from after October 5th to the end of 19. So
I'm sorry, say it again. You have a capital gain from when?
Post October 5th, 2019.
Okay. All right. Good. All right.
Yeah.
Thank you.
Yeah. So those I need to refile my 2019. Now I have the EIN and everything. I'm ready to go do that. My guess is I don't have to do anything so I'll do it for my 1040 federal, but I don't think I have to do anything for my California taxes. I just leave those as is, right?
To be honest, I am not familiar with California taxes because they have been scaring taxpayers since probably 1920. And so, they're always up to something. And so that's not an area that I deal with.
No worries. Yeah, they're non-conforming.
There's also a third form, the 8997, which basically shows, so the 8949 is, you file it in the initial year in which you invest, and in the year of any disposition. The 8997, there's like all these different forms, right? That is one that you file every year. So you say, I'm investing money from 19. So then you have the initial form of 8949 and the 8997 in the year of the initial, what's considered to be the initial investment. But then you file the 8997 every year, because it's basically it's saying, I'm continuing to own an asset. I have not disposed of it. This is the beginning balance as of January 1. Here's the ending balance as of the end of the year. And so then it'll be consistently reporting this.
Got it. And for Eng's sake, I think hopefully we'll be adding to that balance, right, as we invest more. Yeah. So my next two questions are more for future tax situations. So
yes,
I'll stop and see if anyone has any specific 2020 filing ones first. I didn't want to eat up time.
So guys, we're just gonna do a free form. If anyone has any questions, feel free to unmute yourself, ask Steve. If not, I have a few questions from emails. So I do have a question from the email from somebody who, I'm just type it out in chat so you can see it, Steve. It's quite a lengthy question. So somebody contributed 50K in 2020. I have 42K of taxable capital gains in 2020 and 8K in 2019. They include both long-term and short-term. My wife and I use the tax filing status married filing jointly. His questions are, how should I indicate in my 2020 tax return that my 42 cap gains is offset by the 42K contribution to QZF?
Okay, so because I see all this different, there's all these different participants, so I'm not actually, so I'm just gonna tell you, so I'm not gonna keep in track the dollar amount of what he invested, right? I'm just gonna say, if you had capital gain in any particular year, right, the year in which you're investing, so it could be 19, end of 19, or it could be 20, I have capital gain of 50, right? We're going to use that number. And this is what I was saying to Patty before, on either your Schedule D or on your Schedule 4797, based on the kind of asset it is, you have on the, on the line, it'll say, this is actually in the materials when we had forwarded, income tax reporting, there's actually in that packet, and if anyone needs it, we can re-forward it. So I actually updated, the forms ever so slightly based on 2020. From 19 to 20, the forms changed slightly, and because that might throw you off, I kind of redid the 20 forms. But so you say, I sold 100 shares of Apple. That's on line 1, right? Directly underneath that, you put in the name of the fund, there's tax ID number, and the amount invested. So my gain is 50, and then I have this negative number directly underneath it, which is the amount that went into the fund. So that goes directly on either D or 4797 based on the kind of asset it was. So it's directly underneath, what it is you sold. And then also is added to the 8949, which is filed in the year in which you invest in an asset. And so those two forms will jive with each other.
So that's form 8949.
8949 is a form that you attach to your return in the year of initial investment.
So
and
this one, right? Can you see my
there you
screen?
go. Look at that.
So they will put in the Apple shares or whatever the date you acquired, they sold, to highlight long-term, short-term, right?
Yeah.
The cost basis, and then the
So then you have this code. So you kind of skipped over the code. So
Yeah.
code F is for somewhat unusual kinds of capital assets. So look at the so it would be things like straddles, 1258 gains from contracts and straddles, some other issues, right? So just keep an eye on those instructions, or if you have a preparer doing it, the preparer will do that. And then you obviously have the amount of the adjustment.
Yeah, and so then right below that is where you put in your
No,
investment.
it's actually so it's on the schedule D or
Schedule D.
4797 is where you have the negative, you have the positive, and then the negative number directly underneath it. This statement here is just basically describing what you sold, right? So that they're matching the character of the gain. So if it's collectibles, it'll be 28%. If it's depreciation and recapture, 25%. If it's short term, right, it'll be ordinary income. If it's long term, it'll be, whatever that rate is based on your income level.
What was the form you said again?
Okay, so whenever you sell a capital asset, it's going to show up on one of two forms. And this is for all time. This has always been this way. Either Schedule D. And so here's the form, right? So this is for part 1 is short term, part 2 is long term. That is where you normally would report these transactions. And so and then there's actually an attachment to this. There's a second page, which gives you more space. If you can go down to the next page.
I did.
Okay, there's actually an attachment if you need more space.
Oh, I see. Yeah.
And so you say, this is what I sold, and then you have the negative number directly underneath it. And so this is where you show it going in and out. And then you also have the 80, and then the 8949 is just basically reinforcing, this is what I sold, that this is what I invested. This is the gains I invested. So you could theoretically have had 100,000 of gains, but only invested 50, right? So the full amount goes on to the Schedule D, and just the amount you invested goes on to on the 8949.
Got it. See,
just on that one real quick. Conversely, if you had two different capital gains you're offsetting with opportunity zone investment, would you break out the opportunity zone investment into two lines?
I'm sorry, say that one more time.
So if you've got two stocks that you sold with capital gains,
Yes.
in each for 25K, and you invested 50K into the fund, would you break out that OZ fund line
Yes.
into two different lines? Okay.
Yes, because
Thank
you would say I have stock. You have shares of stock of Apple and shares of stock of something else, whatever that is, and so you're saying I had 25 from this stock and 25 from this stock, because if you only had 25 of gains from the first stock but then said 50, you know that would come back to haunt you with the IRS. You would get a series of letters lasting over a period of maybe up to 3 years where they are questioning you on this. So the way the regs talk about it is you need to separately state out each one. You should not aggregate.
Okay.
And then it's also true on dispositions as well, of like if you dispose of anything within the fund, you have to do it, each investment has to be broken out. You don't aggregate it.
Okay, thank you.
Okay. Are there any, this is a generic question, are there any other considerations I should be aware of in order to correctly report the QZF investment with the corresponding tax deferral, besides what you've been saying?
Yeah, so if they don't have the administration of income tax reporting for investors that we sent you before, they don't have the updated 2021, we can resend that out. We will send, I'm going to send it out to you anyway, but you can then forward it on to any investor. And in this material, we have, just like you're doing before, we have the actual snapshot of the form, and we have sample language telling you exactly how to do it.
Yeah, this is the form that you, it was a Word doc, right? This form? Do you guys see my screen?
As soon as it shows up, I'll
Okay.
hasn't said it yet.
My screen share is not great. This happens all the time in Zoom. I'll move on to Brandon Lee's question. Unless you want to say it, I'll read it.
Go ahead and read it.
For Form 8997, if the
Yes.
Jacksonville QZF
Yes.
is the only thing I invested in, I only need to fill out sections 2 and 4. And the totals for each section should be different since I am offsetting 2020 gains and 2019 gains, right?
Well, okay, so if you are reporting 2019 gains, that has to be done on your 2019 return.
Yep, so it's 2.
Right? And then anything that you invest in 2020 from 2020 gains will be on the 2020 return. So you can't aggregate 19 and 20 on the same year. You've got to go back to 19, amend that return, and show the deferral of the 19 gains in 19 on an amended return.
And so the combined investment in 19 and 20 would equal your combined investment.
So yeah, the 8997 will show you file that every year, and it will build from year to year. It'll show your additional. So you have perhaps one entry for 2019. I invested $50,000. Then in 2020, you'll add the next investment in 2020. This is now, I have now 2 investments, one from 19 and one from 20.
Makes sense.
And remember, any year you make an investment, you have to file the 8949. So in this year, because if you have an investment from 19, you have that form in 19. And if you make an investment for 2020, you have that form again. You only have to use that form though in the year of investment or disposition. But again, the 8997 is every year, because it's like a running total of what you've invested and if you've disposed of anything.
I see. So if you file amendment for 2019 and file for 2020, are you essentially doing a running total from based on your amended 2019?
Yes, you're going to just have to imagine that you filed it correctly, even though we know you're filing an amended return. it's as though they'll keep up with that. The IRS will keep up with that. They'll say, okay, here's the 19 return. It came in, it's amended. That's fine. We have a running total, and then you do 2020. Even if the returns are prepared at the same time, even if you file both of those on the same day, you take the assumption that the IRS has it, received it. You don't have to explain anything on the 2020. You don't have to say, see my amended return from 19. You don't have to worry about that.
Got it. Anyone have questions? Or Patty, you want to go?
If anyone doesn't have any more filing questions for 2020, first of all, Ang and Steve, thanks again. I know you guys, can't counsel on tax and fortune telling and all that stuff in the future, but I am starting to look into the future in terms of the deferred cap gains, how to handle that for like estimated taxes and stuff like that, and also AMT. And also, I really want to do it from a purpose of then investing more in 2021 OZ. I mean, add into my 19, add into my 2020, hopefully add into, and your next 2021 OZ. So that's the preface to it. First question is, for 2026 tax planning, with all the deferred cap gains, is there a recommendation or a schedule of estimated taxes that we should plan for that year? I just don't want to have any like underpayment penalties or withholding penalty considerations.
So in this particular case, since these investments are taking place in less than, to make sure, so so for the investments that were deemed to have been made for 19, if any of you have an investment that you're amending going back to 19, in that particular case, you'll be qualified for the 15% permanent elimination of gain. So let's say, for example, you have $1,000 of gain, right? So you will then only owe tax on 850 of the 1,000 of gain, right? Based on the character of what you have. So if it was a long-term gain, you held the asset for more than a year and a day, and it's a capital asset, then you would take, and this would be whatever the rates are in the year 2026, right? And so you say, my applicable rate, let's say it's 20%, right? In 2026. And you say, I invested $1,000 of gain in 2019. I am then responsible to pay tax on $850 times the 20% bracket. And then that is my tax I owe for 2026. Now, for anything you invested after 19, so 2021, anytime thereafter, you're now within the 5-year window, right? There were two windows for deferral, 7 years and 5 years from the date that the tax is due, which is 2026. So in this case, you invest for every $1,000 that you invest in 20 or 21 or thereafter, then you would owe tax on gain of 900 times, we'll say the rate is 20%, right? And so then that's how you know what your gain is. And so the gain is considered as best as in terms of where the regs stand now, the gain is considered to have been incurred on the last day of the year. So in terms of your estimated filing, there's two ways you can do your estimated filing, right? You can withhold money through your salary, and it's considered, no matter what day it's withheld from your salary, it's considered to have been withheld pro rata for the whole year, right? And so you can adjust your wage withholding near the end of the year and say, I want all of my wages for some time period, the month of December, whatever it is, to be withheld by my employer, and that will be considered to have been withheld ratably for the whole year. For those of you that are either not employed or don't want to do that, then you can simply make your payment by January 15th of the year 2027, which would be within that estimated period. You would say, I had gains as of the last day of the year. My next filing date is January 15th. You would make your payment by January 15th to avoid estimated tax penalties. And then of course, the estimated tax penalty period lasts until you have to file your return on April 15th. And then if you have any tax deficiency of any kind, no matter from whatever source, then that kicks in the failure to pay penalty, which is different than the estimated tax penalty.
Got it. That's helpful. I just as we hopefully accumulate more these deferred cap gains, I just needed a plan for that
Sure,
in terms of
absolutely.
timing.
That's how often I get an audience of people who want to hear about tax talk, right? It doesn't happen all the time.
Well, Eng's started us on this road, so I'm running hard.
I want to note that, what Steve said is the cap gains rate could change for both long-term and short-term in the future. In the case of California conforming, would that change anything?
Actually, I saw something, what was it? I just saw the other day about California. They disconnected from the federal on a particular issue. I can't think of what that was, but in terms of the rate, California has its own rate, right? And then the question, so they can only charge, what their own rate system is. That doesn't affect the federal. What California does cannot affect the federal, but they can change their rules as to how they tax you. But right now, short term is ordinary income. So right now, ordinary income rates, they could go up, but it's not likely. It could go up, but if it's not likely, or not very much, at least maybe a point or so, but they're already fairly high. It's the capital gain rate and the corporate rate that are more likely to change. I think they were kicking around the idea of 28% on the corporate income tax rate. The reality, of course, is that even before 2019, the effective collected tax rate of corporations was like 9%. Right, so 9, not 90, 9%, and so they were well below the 21% anyway. It's all kind of smoke and mirrors, honestly.
Thanks for the appreciation.
Yeah. So my last obscure question is more around AMT possible triggering in 2026 once all these cap gains are realized and put onto the 2026 filing. Any advice or considerations that we should plan for now before we get to 2026?
I would just, that's something we can talk about in 2026. I don't think there's really anything. It's not likely, it's not likely there's going to be changes in AMT, but that's something we can talk about as we get closer to it.
Got it. It's for me that basically it's this is the last big year for me for 2021 to look at opportunity zones, because we're still within that 5-year step up, right? So if I want to do something, I just want to plan out my investment budget for Eng for the rest of the year.
Yeah, right.
Yeah. And then, if you invest in 2022, you don't get a 10% step up. It still would apply. I don't know how good of an investment it would be. For future capital gains, you would get a benefit if you hold for 10 years. Of course, most opportunity zones hold for 10 years. We will hold for 10 years. The future capital gains elimination applies to depreciation as well, right?
Yes.
Because that recapture is converted to long-term capital gains. So it's structured, it's taxed slightly differently, right?
Well, okay, so I think you said he had a couple of things in there. You said so number one. So there's several pieces to this, right? So we'll just take this piece by piece. So you have so let's talk about 2020, right? Because this is the year people invested. So in the year 2020, you had capital gain. And we'll use the made up number of 100,000. You have 100,000 of gains from the year 2020. So the way opportunity works is, number one, you have deferral. If you invest, you then defer the capital gain otherwise due for 2020. You defer that into the future, in this case to 2026, 6 years. Number one, you defer the tax 6 years. That's benefit number one. Benefit number two is that they will eliminate permanently 10% of the gain, therefore 10% of the tax to be paid in 2026. So rather than being taxed on 100,000 of gain, you only get taxed on 90,000 of gain. So that's benefit number two, right? So then you say, okay, I'm invested in this fund. So I've invested in 2020, so we have to wait until at least past 2030 to sell your interest, your membership interest in the fund. So the assets owned by the fund can change. The assets inside the fund, right? Let's say the fund owns 10 pieces of property. The fund can buy and sell those properties inside the fund, and provided that they are reinvested either through a 1031 exchange, or if it's done before 2026, it's done, they immediately reinvest within 180 days, then there'll be no tax that flows out to the members, right? No tax will flow out. Now, if you don't reinvest and you simply decide just to sell something, the gain will flow out to the investors, and they will be taxable on that if you don't reinvest the money. But provided you do reinvest the money within the rules, then there'll be no tax during the 10 years, right? Then what happens at the end of the 10 years, you say, okay, we're going to pretend that we're going to sell everything at one time. That's not likely, it doesn't matter, but I'm just going to use that as an example. We sell everything on June 1st. What happens is that the assets, when they are sold, there's a tax election that each investor as a person gets, right? Each investor gets this, that says that my basis in the assets sold is equal to fair market value, right? So you sell the asset for, 50 million, the basis is 50 million, there's no gain or loss at that juncture, and it doesn't matter that you took depreciation deductions during the term of this agreement, right? Because everything is stepped up to fair market value. So depreciation and recapture only happens when there's a difference between your basis and the gain amount, right? So you say the property is selling for 50, but the basis is only 40, right? Why is it 40? Because I've been taking depreciation deductions every year, right? That's why it's less. And so all those are forgiven, so to speak. And that is actually the only time in the 3 or 4 years of taxes that's happened. They've never forgiven depreciation before, but they were feeling especially generous in 2017, and so that is actually a huge benefit, because really the ideal circumstance, which of course this is a corporate strategy, which would be take as much depreciation as you can, let those losses flow through to all the members, and then when you sell it, there's no recapture. So the money you receive, so if the sale is 50 million, and after you've paid off the debt, if there is any, then all that money goes into the pocket of the members.
Yeah, and that depreciation during the hold period, the 10-year, can offset the cash flow from the investment potentially. If
say it again, the appreciation is not taxed, right?
The depreciation losses that we flow to the members.
So you get your depreciation, and you'll have basis in that depreciation, because each member will get basis, number one, in the debt that's borrowed, right? Mm-hmm. And then they'll get basis when they have to pay their tax in year 6. And so they'll be able to utilize that depreciation that flows out to them.
Yeah, so they'll be utilizing that depreciation to offset other.
So if we just use a simple example, you say, I invested 100,000. The entity borrowed money. So let's say they borrowed in terms of that share, you say I put in 100 and the entity borrowed another 100. So the whole value of the project is 200. And so they'll get their percentage interest, of the deductions and the income as they flow out over time. And again, like I said, it doesn't even really matter for those people who understand the idea of capital accounts. It doesn't even matter what your capital account is, because the inside basis of the partnership is equal to its fair market value. And so when this flows out, there's no tax. And so from our point of view, we don't even really care what the capital account is, right? Because it gets washed away. It doesn't matter. Normally that would never be the case on a normal partnership, but that is the case with these. I'm sure that was very confusing to at least half the people, but you just have to know it doesn't really matter what your capital account is.
I'll translate to the rest of the group. Steve basically said the operating zones are very tax advantage. It's great. You don't have that.
It's a good thing.
Yeah.
As a technical term in tax, good in tax law is,
Yeah. Anyone else any questions?
Hey, this is Peter here. Can you guys hear me?
Yeah. Hey, Peter.
Hey guys. Just from going back to the 2020 kind of capital gains, let's just assume I have short-term and long-term. Would it just seem logical then that the right move would be, if I'm allowed to just allocate the money that I've invested into the opportunity zone against any of my capital gains, then the logical move is to allocate them against short-term? Or is there some impact to that decision?
No, the question you say to yourself is, the general rule of thumb in tax law is delay taxation as long as possible, right? Delay it as long as possible, and let the money grow for as long as possible. So that's true whether you have a retirement plan, an IRA, an opportunity fund, whatever that might be. So if you have short-term gains and you would otherwise pay, a combined rate maybe of, you might be as high as 50%, in California, if that's where you are, then yeah, you're not paying the tax, you're pushing it off for 6 years, you're letting it grow. And so, yeah, that would be a logical conclusion to draw.
Right. And with the basis step up, right? Because that 10% would apply when I have to go eventually pay this on that short-term gain. It's still a short-term gain, but now my basis has gone up. So I'm maximizing that benefit of the basis increase.
Well, and also because you're not paying tax, if this is with regard to money you received in 2020, then 10% of what you would owe is being forgiven permanently. And so if that's a high number in terms of the tax rate, then it's a bigger benefit.
Right.
That permanent deferral is better if it's a higher rate. So that would be true whether it's collectible, which is 28%, or depreciation, which is 25%, or in the case of short term, which is ordinary income, which is whatever your income bracket is. So it can depend. It depends on how much income you're making, because that bracket keeps going up.
You see, if you said something really interesting. You said depreciation. Can you invest depreciation recapture as a capital gain?
So depreciation recapture, the 25% depreciation recapture, which is the straight line real estate depreciation, that's considered capital gain. So if you say I have depreciation recapture of $100,000, I can use that gain to invest. So I can pick and choose which gain I want to use.
So for example, say somebody sold a house for $1 million. Their cost basis is $800,000, and $100,000 of that is from appreciation, $100,000 from capital gains. If I'm depreciating recapture, so the tax is different rates, right? 20%, I believe, long term, assuming long term, and then 25%. You could, if you only had 100, you would just put in the full recapture one, right?
Yeah. So depreciation and recapture is reported under 4797. So that's the form you're going to use that on, and that's where you can say this is my gain I'm excluding.
Any other questions, guys? Don't be shy.
Hey,
Oh, yeah.
oh, sorry, just one more from this, Peter, again. And I think you covered it, so I don't think I need a long answer on this one. But from an, I'm not overly familiar, historically haven't had to deal with sort of the estimated tax process with the IRS. I think what I heard was that if again, if my only involvement here is that I've put in money into an opportunity zone in the year 2020, my main concern is at the end of 2026, I have an obligation to either through withholding through my employer or making a payment on my own, making some type of estimated tax payment by January 15th of the following year.
Yes.
So that I avoid penalties?
Yes.
Okay, got it. Got it. Thank you.
That's a great clarifying question, Peter. I like that one. Hey, Eng, more of a fund investment question. For 2021 OZ, is that just going to be an expansion of your 2020 fund, or is it going to be a brand new fund?
So
Thanks, Steve.
So you say, okay, the way that the fund works is it is sensitive to so you say I'm investing money into this project, right? And so each project has an identified investment, right? And so when you put more money in and it goes into a second project, there's two ways to handle that. Number one, you can say, I'm putting all of my money. And again, this has to do, like, for example, if you have 2019 gains, they have to go into the 2020 project, right? Because you had a deadline to get that money in by the last day of 2020. And so those monies, any monies from 19 have to be designated for the initial project of the fund. If you had money from 2020, and so you have some time either to put it in as the last day of the year or into 2021, then you could choose, which one you wanted, right? And so your option is you can say for 2020 money, you can say, I want all of it to go into Jacksonville, or you can say, I want to split it between Jacksonville and something else, right? And so, but the way it goes in is on these projects, you have on each project, you have a specific amount of capital that is required to go into that. And so you say, I'm putting money into this. And then the fund itself says, what are you doing with this money? And they say, okay, well, we took an X amount of dollars and it's being allocated to project number 1. And then we're going to take an X number of dollars and allocate it to project number 2. So within the fund are these projects, 1, 2, 3. And so you can either choose to say, I am in project 1, or I'm a mix between 1 and 2 and 3, or whatever that might be.
And that's from a tax perspective, right?
Yes.
From an ownership and returns perspective, it's not as directly correlated.
Well, so for tax purposes, we have to dot our I's and cross our T's. Like, we have to be very specific about how, because again, it's all very time sensitive, right? We have to get the money in by a certain number of days into the fund for them to use that money for a project, right? So, for example, if you put money in 19, it couldn't be allocated to something that happened in 2022, right? Because it would be too far away in time, right?
Mm-hmm.
So the agreements will reflect the allocation in terms of how that is blended economically at the business level. That is something up to the management, Eng, and the management of the fund.
Yeah, So Patty, just to FYI on that, it's an expansion. So it'll be the same fund. You have automatic diversification into the additional properties, but from a tax perspective, we'll allocate accordingly to make sure that it's as tax advantage as possible.
Great. Great. So just the lazy part of me, if I use the same name fund every single time, that just makes it easier and clean. And then as a corollary, what is the recommended name that we should use on our tax form for the fund?
So TUSI is the fund, right? That is the fund. That's the one. That's the parent entity. That's the one. That's their tax ID number. They're the one you're going to put on, because it doesn't matter what the subsidiaries are. They're not. They are not actually. They're not considered independent, so to speak. They're just subs of TUSI.
So do I use like TOSI Jack's Growth? TOSI?
No, just say TOSI.
In the EIN.
Yes.
Yeah.
Yes.
So if you invested in both the income and the growth, that's considered one investment?
Yes, it is. Yes, that's exactly right. Because so if you have 2 or 3 different classes, let's say you just have various classes of investments, for tax purposes, you're viewed as only having one capital account, right? Even though you're saying I'm in class A, class B, class C, whatever that is, right? I know there's like income and growth so far, right? And so it's all just one. It's all invested in. The fact that you're choosing a little bit of this and a little bit of that does not affect how it's reported for tax purposes.
Got it. Okay, thank you.
Any other questions? Do you want to jump in?
I have a quick one, more procedural wise. If I have multiple qualified opportunity zones, do I use the same form, for example, 8949 to detail, 50K on Fund A, Fund B, and Fund C, or do I use 3 different pages? It doesn't matter. I'm saying
So you have, let's say, let's make up, you have like Apple Fund, and you have, Brown Fund, and then you have TUSI Fund, right? You have 3 different ones. So with regard to my recollection is that you use 3 separate forms for those.
All right, thanks.
I have another question. So let's say if I sold multiple times within a year a particular stock, like how do I? Let's say in the multiple times, like few times it's short term and few times it's long term. Do I have to report every single sale and then say this part of the sale kind of went into?
The answer is yes. The short answer is yes, because each sale is its own, and this is a tax word, right? Recognition event. Each sale is a recognition event, and if you're doing this as a human, not through an entity, then the 180 days starts on the date of the sale. So if you sell a set of stocks 4 times, May, June, July, August. Each one of those events has their own 180-day sale period, right? June 1st, July 1st, August 1st, September 1st, whatever that is. Each sale is its own event. And so each one is a separate event, and each one has its own separate ID period to get the money in. And that's also true for an installment sale. I sell something, let's say I sell a piece of real estate, and I'm going to receive 20 payments. Each payment is a separate sale event, even though you say, it's only one sale, right? But every time you receive a payment on an installment sale is a new sale event. So if you get 20 payments, each one of those is a separate event. And so you would treat that if you were investing in a fund, you treat that as each one is a separate event. Each one has its own time period, and you have to adhere to that. So you have to make sure that if you're doing this as a human, your 100-day period starts on the date of the sale. So you don't think, well, I can do this for the whole year, and then because where all this was kind of bundled together for 2020, it had to do with the IRS had a ruling that says, because of COVID, because of all this stuff going on, we're going to allow you to reach back and treat all this as one period. But that's not the case in 2020 or 2021, right? I'm sorry, 2021 is each sale event is its own event.
Thank you.
Hey, Steve, I think you just covered this, but just so I make sure, in 2020, because of the extensions that I guess it's the IRS granted, it kind of makes it moot, right? If I sold a stock in January versus I sold a stock in October,
yes,
I can invest whenever the gains whenever I need to. But your point is, in 2021, we no longer have the benefit of these extensions, as we know, so we have to rely on 180 days. We should be using that as got it.
So yeah, and it's important for everyone to know that that was only for 2020, and it was because of COVID, and it's because the IRS actually physically shut down, for, I don't know, 6 months. And so they got, if you can imagine how far they got behind, right? Imagine if you didn't answer your email for like 6 months, what a disaster that would be. So that's only for 2020. Don't be lulled into that. If for anything happening in 2021, each sale event is its own event.
Steve, isn't there a new provision around a second extension of that March 31st deadline? I know not December 31st deadline to March 31st.
Are you talking about the recent extension for COVID?
Yeah.
I don't have that memorized, but I'm just saying, the safe thing to do for 2021, we can add that notice to this tax thing. But it's, for 21 purposes going forward, it's important to, not to treat the 2020 rules as the general rules. I usually memorize things on Fridays, so that's tomorrow.
Okay. Anyone has any last minute questions before we break? All right.
Did you answer my question in chat? Because I had to step away because I had put out a fire at work before we speaking.
Yeah, we did. And then we talked about the individual stocks. You had to break each line item for individual stocks as well.
Okay.
Yeah, we'll send the recording out to everybody. All right. Thanks, Steve. Thanks, everybody, for attending and answering questions. If you guys have any other questions, feel free to just email me. I'll try to forward to Steve and not pass him too much.
All right, sounds good. All right, thanks, everyone.
Really helpful. Thank you.
Okay, thanks. Okay.
Thank you. Bye.
Thanks.
Bye.